Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Marc Chandler from Bannockburn Forex. Good to see you, Mark. How are you?
Good. Always a pleasure to see you.
It's so great to have you here because we got past a couple of central banks this week that we're going to talk about. We have the Fed next week. We got inflation data. We got CPI, PPI, got ECB, Bank of Japan. We got a lot happening right now, and the market seems like it's poised to move. So I'm really excited to talk to you today.
Good. Yeah, and I think this is perfect timing. I don't know how you technicians know this timing so well, but you got it.
Well, let's before we get too deep into the conversation, I want to say that today we take, and for those of you that don't know, Mark blogs every day, and it's really a staple of my daily to do things is to read what Mr. Marc Chandler says on marktomarket.com, and I like to. But we get it over at Trader Summit, and I like to read just his morning opinions about what's happening in the markets. You've been doing it for how many years, Mark?
More than I want to admit to. More than 30 years.
My goodness. And I remember you, and I could name off two other people that I've literally been reading since I got into the currency market in the early 2000s, like 2001. So I love your commentary, and that's why I just really enjoy being here with you. But more importantly is if you go to, and I'm just going to show you really quick, and I found it really fascinating. You go over to Mark's blog, and you pulled up a chart, or you put up a chart today of the wildfires that are plaguing Canada right now. But tell us a little bit about this chart and why it actually matters to people today.
Yeah, so first thing you can see that, we always joke about how polite Canadians are. And here on the good chunks of the U.S. Northeast are under a cloud of smoke from the Canadian wildfires. And what this chart shows, I think, is that wildfires in Canada are not uncommon. What makes this year particularly unique or special is that it's happening a couple of months earlier than usual. And that speaks to the drought they've had. And so then I think, well, what does this really mean for the bigger picture? And I think it's very much relevant to discussing about the Bank of Canada surprise in the market this week, 25 basis point rate hike. And about 2 or 3 weeks ago, the market was pricing in rate cuts for Canada. And so what happens? I think oftentimes in the market, you get this overcorrection. Like we get surprised by officials, and nobody wants to get bitten by that same dog twice. And so it swings really hard, perhaps exaggerates the other way. What these wildfires mean in Canada is that the Canadian economy is going to slow down. This is an adverse economic shock. Besides the tragedy for the environment and the people and property and all that, it's an economic shock, a negative economic shock. Mm-hmm. And so, the Canadian economy grew. It was really the fastest growing in the G7 in the first quarter of the year, which is partly why they raised rates. And so now what has the market done? It's pricing in not only another rate hike in Q3, but even another one in Q4. And seeing these wildfires tells me that unlikely. That is to say, they're going to get some weak economic data. And this is coming at a time, and this gets us grounding back into the price action, where the U.S. dollar has fallen, partly because of the rate hike from Canada, surprising us, it's fallen to the lower end of, say, 3 or 4 month trading range, say in between 133, 134. And so we're at the bottom end of the range, and I think we're tempted, given the probability that the Fed doesn't raise rates next week, given the temptation then really is to play for a breakout. Bank of Canada just surprised us. It's hawkish. We thought it was dovish. It's hawkish. And so maybe we should play for a breakout. But I think that I think that's one way to play it. But I think that it's more prudent and maybe a better risk reward is to assume that when you get in a trading range like this, it's so clearly identified, you've got this fundamental news out there, that you play for the range to hold. So you play for the range to hold unless proven otherwise, which means that I find that I keep finding new ways to lose money, but there's only 3 ways it seems to me to make money. You either go with the trend, which means buy low, sell high, or in either order you want. It also means you can also make money then going with the trend. You can make money sometimes fading the trend. Mean reversion type strategy. And sometimes, like now, I think it's basically to play the range, which is difficult because it means buy low and you have to sell high. And so, yeah, on your chart, you can really see we're testing the lower end of the range. I say that given the uncertainty about Fed policy next week, given the possibility that the market's overreacted to the a surprise move by Canada. I'd rather be thinking that we're closer to a low than we are to the high. And so I think the risk reward for some of our clients at Bannockburn, some of our clients who need to be buying U.S. dollars, who have to basically have revenue from Canada they want to repatriate, this seems like a reasonably good opportunity, given where we are relative to the range and given this news stream.
That's interesting. And tomorrow we have the Canadian jobs report, and I think this is a good place to actually pause and talk to you a little bit about labor. Canada's jobs market jobs reports have been extremely strong for Canada, obviously, and same here in the U.S. I mean, maybe it's more of a North American issue. Do you think that's gonna pose a problem with this idea, the strategy of these 133 level or so?
Yeah, so they raise a good point. Canada raising interest rates like the U.S., the jobs market has been fairly resilient. In fact, I was just looking at the numbers for how many jobs Canada's created per month this year compared to last year, and how many of those are full-time jobs as opposed to part-time. And the numbers are almost identical, which means to say that the labor, despite the vagaries of the economy, the labor market remains very strong. My sense is it doesn't really matter so much for how the market's going to think about Bank of Canada policy. It's not going to be so much on the jobs data, because 1 month's not going to change the view that the jobs market's resilient. It's going to take more than that. And what Canada pointed to was, the Bank of Canada pointed to was basically still strong demand. Like stronger demand, so they've got to weaken demand because demand is in excess of supply, they say. And they talked about, and this is what I find interesting, is part of our job is to, sort of like what Keynes thought, I think, of, he once called about the market, said they're like a beauty contest, not to pick who we think is the most beautiful, but to pick who everybody else is going to think is beautiful. And what the Bank of Canada told us was an indicator that they watch. They said the 3-month moving average of the underlying, that's their core rate, but they adjust it for the trim. They cut off the excesses. So they got some underlying core measures of inflation, and they looked at a 3-month moving average. So my suggestion that for people who are looking at the Canadian dollar, you want to know the impact on policy. I won't so focus on labor market, which, like I say, is slow moving. It's been strong. It's not, one number is not going to change that assessment. But inflation is a different story. And the Bank of Canada basically told us the inflation measure that they watch. Okay. And so that's how I would incorporate that.
Okay, well, thank you for your answer on that. And Mark, and speaking of inflation, since we are we have the CPI and then the producer prices the same day as the Fed, and obviously we've got a lot of disinflationary pressures coming through the market, at least, and I would say globally. There's certain pockets that are showing some relatively stickiness, if you will. But how do you feel the Fed's looking at inflation now, based on how good of a job has Powell and company done thus far, and where do you see them factoring that into what they're going to do in the months ahead?
Yeah, it's kind of funny because I'm of course, a guy like me, I've never played football, but when I'm watching a football game on a Sunday afternoon, I'm telling the coach what he should be doing and criticizing the coach. And so here we are, as trying to as investors, and maybe helping other people invest, and somehow we think that we know more than the Fed, or we think we can criticize the Fed. And so I kind of think of the Fed as I don't think about what they should do in in ought cases, like what they ought to do. I think about how they've done relative to other central banks, and I think about how they've done compared to their own metrics. And so my sense is that it doesn't really matter. That what really counts is how the Fed sees its job. And I think the Fed has been very clear. For me, not all Fed officials are equal. I put a lot more weight on the Fed's leadership. And there's 3 people who are in the Fed's leadership: the chairman, the chairperson, the vice chair, and the New York Fed president, because the New York Fed president takes care of all the operations, and he's the only regional president that votes at every meeting. And he speaks for, as the vice chair of the FOMC, he also then is part of the Fed's leadership. And so I have been leaning towards the Fed raising rates, and the market was leaning that way too. Before the jobs data, there was about a 70% chance, right through the Fed funds, that they were going to hike. And that's such a high probability that the Fed would probably take that and not want to disrupt the markets by becoming more dovish in the markets. But what happened was and this is an element of power that I think that is sometimes underestimated, and that is the communication channel. It seems to me that the Fed's leadership, first it was Powell, And then I put Governor Jefferson, who, as I say, just a governor, but he's been nominated to be the vice chair. And most likely he will become the vice chair, which means that just through the nomination, he no longer can just speak for himself, but he's got to also speak as part of the Fed's leadership. And so Powell, Jefferson, and then Williams all talked about pausing. And the markets, I think, many people, I don't know what happens in that. I just see the way the markets responded by looking at the Fed funds futures. And they responded accordingly. That is to say, they took the odds from, say, 70% chance to something around 25% or so now. And so my guess, though, is, and this is the problem the Fed's going to have. First, they're going to say most likely pause. I hesitate to say skip, because skip sounds like they know what they're going to do in July or in August or September. So
Sure.
I think that a hawkish pause, and the way they drive home that hawkish pause is by saying it's just a pause, so they can monitor incoming data. But here's the other way that they're going to do it: is the Federal Reserve announces new forecasts. It's called the Summary of Economic Projections, and you can Google it. You just Google Summary of Economic Projections with the month, like March was the latest one, and you'll see that in March, the Federal Reserve, the median forecast was for 0.4% growth this year. We've essentially done that in Q1. And Q2 GDP looks something around 2%. So the Federal Reserve pauses, doesn't raise rates, but then revises up its GDP forecast. And what's going to have to do is it's been more pessimistic about the jobs market, like we were talking about how resilient it is. And so they, I think, had I want to say it's a 4.5% median dot for where unemployment was going to be. That is well too high. And they're probably going to have to lower that. And so they drive home the idea of a hawkish hold by not just Powell saying we're waiting for incoming data, we're data dependent, that kind of mantra, but they'll also do it through the I want to say the communication channel of the Summary of Economic Projections, which are publicly available. You can see the variance and the ranges and all that. And I think that's going to be the message. And what I'm thinking is going to happen, and again, it's not like tell you the truth, I'm sort of like partly I'm surprised whenever I say this, because people think that because of what I do that I'm an economist. I'm not. I've taken very few economics classes. The way I've got my economics, besides on-the-job training, was through reading about history. And it seems to me that so I'm not a rocket scientist when it comes to this. I'm just like, I just say sort of cool head rationalist. And what I see happening is that in May and June of last year, inflation jumped. Last May, it rose by 0.9. Last June, 1.2%. May, those are just shockingly large numbers. So what's going to happen is those numbers are going to be replaced this year with lower numbers. And if you make some very conservative assumptions, like they get replaced by 0.3 or 0.4, we're talking about inflation before the Fed meets at the July meeting. They will know that inflation, headline CPI, will be close to, say, below 3.5%, a little bit above 3%, somewhere like down there, 3% handle, definitely below 3.5%. In the best possible world, it'd be below 3%, but unlikely. But the idea is that if the Fed pauses in June next week, can they really resume hiking in July when inflation would be falling sharply, not because of my forecast, but just simply because of the base effect? And so that's why I think that once they pause, it might be harder to jumpstart it and resume the hike again. Not just monetary policy and inflation, but think about what happened. We just finished this bizarre drama, this bizarre dance about the debt ceiling. And as part of the cost of resolving the debt ceiling, part of the price of paying for the U.S. not defaulting is two things. One is a cut in spending, and that's going to begin hitting later this year. But more immediately, for something like 43 million Americans, student loan payment is going to resume. And that's the average student loan payment in the U.S. is about $300, $350, something on that kind of magnitude. And so starting in September, that means money that people haven't had to pay for a few years is going to be leaving their pockets. And I don't know how it's going to affect things, but we know the direction. We don't know the magnitude, but we know the direction. It's not going to be good. That is to say, it's going to take money away that could be used for spending, buying financial assets, buying other things. Sure. And so I'm thinking that inflation is going to be falling, and we're going to get this fiscal headwind. And so, people talk about permanent inflation, or we're in a new era for inflation. I think that, to me, it's almost like this trading range that we were talking about with the Canadian dollar. I think the most likely scenario in the big picture is a return to the great moderation. It's sort of like after the snake eats the dough, the snake gets thin again. And I think that's what's going to happen to us. We're going to have another long period of slow growth, low inflation, and that's going to that low inflation means low interest rates. Low interest rates, low growth, low inflation, a soft economy. That's going to be the challenge.
Yeah, that's going to be interesting. So, a bit based on what you just said, Mark, and by the way, if you guys and gals listening in, you have any comments for Mark, jump in the comment section down below. I think this is a really, really, really great conversation. But I want to ask you then, you know, a lot of economists, and I know you're not one, you're not, but a lot of economists forecast, you know, rate cuts going into, you know, later this year into next year. Are you in that camp as well?
Yeah, no, I'm not quite there. I thought that would be reasonable, but I think that the economy is still resilient, and I really think that the Fed is going to be hesitant to do so. But having said that, when you look at those that summary of economic projections, the Federal Reserve is signaling a rate cut next year, when inflation, they say, is still going to be above 2%. So you know, a few weeks ago, the market was talking about, say, as much as 3 rate cuts this year. And right now, I'm looking at the January Fed funds futures contract. And the reason I look at that, because there's no meeting in January. Trying to look at December kind of gets screwed up because of the holiday, the finish of the markets, the year-end window dressing. So I look at the January contract, and it's not telling me. Well, it's telling me about a 5% year-end effective rate. And so, and that's my guess is that's more or less reasonable.
Okay. Yeah, and so with that being said, the market still seems like it believes that there are going to be some rate cuts, and you know, one of the reasons why the stock market is trading so well. But let me ask you, since I know you monitor all markets, you focus obviously on currencies, but what's happening in risk appetite obviously you pay attention to. You know, stocks up here at new highs of the year. How do you feel about that, and how does that affect what you're doing in the currency market?
Yeah, so I do watch the stock market. Part of it for me, it's really about trying to get some handle on global flows. I think that the dollar is partly a function of where people are putting their money or taking their money from, and so I look at the asset markets. I tend not to find a much of a correlation with the dollar, like say the dollar index and the stock market. To me, one of the secret things that a lot of people I don't think recognize is how sensitive out of the major currencies. I'd say the yen is most sensitive to U.S. interest rates. I think the Canadian dollar is the most sensitive to the stock market. I find that correlation generally stable above 0.5. And so typically it's more stable, Canada dollar, U.S. stock market. So stock market higher, Canada higher. Partly, I sort of think of it just as a proxy for risk.
Yeah.
And I find that most of the time that correlation is higher. So I'm looking at the change in the Canadian dollar and the change in the stock market. And I do the same thing with oil prices, say the change in the WTI. Right now, say for the last 30 days, is relatively high. But typically, the stock market correlation is more stable and higher than it is with oil. I also follow the 2-year interest rate differential. That doesn't seem to be the key driver right now for Canada. The other thing I'd say about Canada, I think about the stock market, is that, like I say, the correlation is fairly stable. And if that's not working, if somehow that's like loosening, the other factor that I find is kind of interesting is that the dollar index. Sometimes the Canadian dollar just moves because the U.S. dollar is broadly stronger, broadly weaker, not anything to do with Canadian economic numbers. And so, but I do think that the stock, to your point about that the stock market might be rallying because the market's pricing in Fed cuts. I'm not sure that's really needed. I think that all we have to do is, it's sort of like if we were making a semiconductor chip, a nanometer, like the size of the thickness of your hair, would matter. But when we're doing things like with the economy, I just don't know if they get so fine-tuned like that. You know what I mean? That
Right.
It's not like so it doesn't have to be exact and very precise. I think it's just we get the rough idea, and so I think that as long as the market thinks that the Fed is just about done, and that interest rates, and that of course we should expect interest rates to peak before the Fed says they're done. if the market anticipates these things, I think that's really what's helping things. And of course, I think that there's so many of us came into this year being burned last year, being Federal Reserve still raising interest rates, and reluctant to we've really been forced. I think those of us with scar tissue have been sort of forced to like chase the market higher here, and I think that we're not done yet.
Yeah. All right. Well, that's a great answer. It really is. And I think you're getting a lot of that FOMO, or one of my friends, the great Chris Weston, he calls it FOMI, the fear of underperformance, basically. So you might have a little bit of that happening too, right?
Yeah, that's a real driver. And then, but it's not just in the U.S. either, by the way. You know, the Japanese foreigners have been buying Japanese stocks, not just Warren Buffett, who made the news coverage, of course. But I think for like 10 weeks in a row now, foreigners are buying Japanese stocks, lifting the Nikkei, the topics to levels that haven't seen in a generation, like 30 years.
Yeah.
European stocks have also done fairly well. Interestingly, I find is that there's been a change in sentiment. And of course, that's what we're trying to pick up sometimes, whether it's through looking at price action, seeing how markets respond to news. We are detecting a change in sentiment regarding stocks is towards China. The CSI 300, a broad measure of the Shanghai, Shenzhen markets, the big caps, has really underperformed. I think it's the only major stock market down this year. And I just begin seeing, like, from my news feeds and from trying to just like keep our antennae, trying to get that pulse. My sense is that people now recognize some value as the other markets, the developed markets, make new highs, like you say, for the year, or multi-year highs or multi-decade highs. I think people are beginning to look more attractively at Chinese stocks, and same thing with Chinese bonds. You know, say earlier this year, Chinese 10-year yields were at a premium to the U.S. Now they're at a deep discount. I want to say it's about 120 basis points or so, and it doesn't really get much beyond here in the last couple of years. So again, this is another one of those like range trading, decision-making questions, like with the Canadian dollar, with the do we play for a wider U.S. premium over China, or will that snap back? And same thing with the Chinese stock. They've underperformed for a reason, but is that valuation enough to seduce people back into the market?
Yeah, it seems like it has been, at least for the last couple of weeks, Mark. So, hey, you know, Mark, I'm a huge fan, and I have been since I started in currencies. You know, when I bridged the gap from trading equities in the 90s to the early 2000s, first person I came across was you. So I'm so thankful for the opportunity that I get to spend with you. How do other traders get to follow your work more closely?
Yeah, so I'm kind of fortunate in a way. There's so many people that struggle trying to get a presence, you know, have to monetize their web presence. And I've worked for banks who, knowingly or unknowingly, allow me to post my stuff on the internet. So it's free. Like you say, I've sort of it's a good habit for me. It's a good discipline for me. And I try to combine the macro stuff, but I'm a trader at heart. And I try to think, I'm always thinking, what's the actionable? What does this mean for the price action? And so I post something, most mornings it's up there by 6:30 or so in the morning, East Coast time. Sorry for you. I mean, it's the middle of the night for you. You get up to get that drink of water. You can take a quick look. But so that's on the marktomarket.com. And then I do try to update during the day sometimes, especially, you know, when conditions permit, on Twitter, and that's Mark. That's Mark Making Sense, and that really comes from my first book, Making Sense of the Dollar. After about 25 years, I thought I'd write up a book basically that just sort of based on my experience, and I found like 10 things that I thought I was told about foreign exchange that weren't true. And I just sort of wrote up these. It's sort of like each chapter is sort of standalone, like trade deficit drives a dollar. Or, you know, when I first wrote the book, it was I think it came out in the when did it come out? Right before during it was published in between Bear Stearns going under and Lehman going under. Yeah. And at that time, like now, people were saying the dollar's role in the world was ending. And at the time, there was going to be the euro, I mean, of course, this was before crypto, but it was the demise of the dollar. This was before China, and I sort of tried to address it then. And of course, it's sort of one of those issues that need to be constantly being readdressed. But my passion probably would be more in my second book called Political Economy of Tomorrow. And I basically had this idea that U.S. leadership after World War II, we all know about Bretton Woods, dollar pegged to gold, other currencies pegged to the dollar. And Nixon broke that in the early 70s, 1971. And we had this era of Reagan-Thatcher. And I think that era was very important. I think that's when the U.S. began running current account deficits. That was the liberalization of the capital markets. I mean, I was at a bank that issued those David Bowie bonds. Remember David Bowie? He would like.
Of course, I do.
Yeah, he wanted to sell all these he'd sell all these DVDs and CDs every year. And he said, well, why can't I get money? Why can't I get paid up front for this recurring revenue stream? And so we had David Bowie bonds, just the way some like municipalities might have bonds backed by parking meter income. By linking your obligation to an income stream, you typically can get lower interest rates, or in David Bowie's case, he can get his money up front. And so to me, this was really important, but I think the great financial crisis broke that. The Reagan-Thatcher era sort of ended, and I sort of think we're a bit lost now. And that's what my Political Economy of Tomorrow book is about. Is that Reagan-Thatcher, I called it a cash register, broke down. And sort of talk about why it broke down, the social ramifications, and then trying to think about what's going to replace it. And that's what I'm working on now. Really, I sort of thought that nationalism was going to fill in for the Reagan-Thatcher, and we're seeing that in many, the import substitution, whether it's Biden, whether it was Trump, whether Europe's doing it, China's doing it. It seems like the world is doing it.
Yeah.
And so that's what I'm working on, and so that's Political Economy of Tomorrow, and. That's really sort of where I am. So I think that those are the main ways to follow me. But if anybody, the book is out there. You can get it at most places, and you can buy it cheaper than the cover price. Sadly,
I think I got both of mine sitting on my shelf right behind me. They're great. So Marc, I appreciate you, and you can follow all Marc's work. Well, some of Marc's work actually at Traders Summit. We publish a lot of his newsletters pretty much every day. So Marc, I want to thank you, and you know what? This is a great. I'm gonna leave you here, but I would like to have this conversation with you about the de-dollarization. It's something that obviously it's an issue right now. It's something that we could talk. I'm sure you could talk in depth about. That I've had conversations with other currency folks. I'm going to do the same with you here in the next month or two. So be on the lookout.
That sounds great. I hope the dollar's still there.
All right. Me too. Me too. All right, Marc, thank you so much for joining us today. And I appreciate you. I'll reach out to you soon, and we'll have you back on again.
Great. Thanks. Good luck to everybody.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.